Will mortgage rates go lower in 2023? The Fed just raised the federal funds rate another 0.25%, so it's now up to 5.5%, which is the highest level it's been in the last 22 years. Yet upon this announcement, mortgage rates actually went down a little bit. Why is that? How will this affect the housing market? What can you expect in the months to come? And how can you make the best decision today based on the data that we have? My name is Michael. I own a local real estate brokerage here in the Dallas area. And if you're looking to make a move in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that is in the description below. Okay, so first of all, the Fed's goal with rate hikes has always been to get inflation down to 2%. If you'll remember, last year we got as high as 9%. But as of last month in June, inflation was only up 3% from a year ago, although core inflation, which excludes food and energy costs, was still up 4.8%. But to me, seeing 3% inflation is pretty close to the Fed's target of 2%. And at the very least shows we're heading in the right direction already with rates where they're at. But obviously, the Fed seems to think that even though we're only 1% away from their goal, we need another rate hike. Why is that? It seems a bit harsh, right? In my opinion, it's because the labor and jobs market is still too hot. As I said in my weekly update a few weeks ago when the BLS jobs report came out, unemployment is too low, wages increased by 4.4%, and there are just too many new jobs being created. In other words, the Fed thinks that there are too many people making too much money. They want to see unemployment rise, less jobs available, so that people will ultimately make less money so that they can spend less money, which in turn would bring down inflation. So I think even though they're talking about 2% inflation, I think behind closed doors, what they really want to see is unemployment go up and people to have less money to spend. So obviously, inflation is cooling in general, but with regards to housing, which is a big part of inflation, it's not cooling off. In fact, in June, the index for shelter accounted for 70% of the increase of the CPI inflation numbers. 70% of the increase was just from housing. In June, rents went up 8.3%, while owner costs rose 7.8%. That's a lot of inflation in the housing market, though it doesn't seem that the Fed understands these high rates are actually causing it. Initially, basically for November and December, the shock of high rates did curb demand, and prices fell very briefly. But ever since then, what we've seen is high rates have actually curbed supply even more than they've curbed demand, which of course drives home prices up. The Fed still doesn't seem to understand that people are not going to sell their home if the next one is going to cost them double the monthly payment, because both prices and interest rates are too high. So far, the best option home buyers have found has been to buy new construction homes, which are still able to operate in a sub 6% mortgage rate environment. That's because they're able to offer huge incentives. They'll buy down the rate for you, something that most homeowners who are selling their home can't do. As I covered in my video a few weeks ago, Dallas area home builders are actually on pace to have a record year. And if you want to learn more about new construction homes and the huge incentives they're offering, you can watch this video here. So why did mortgage rates not go up with the Fed rate hike? Well, the mortgage market had already priced this in back at the beginning of July, as soon as the jobs report came out. It was obvious that the labor market was still too strong, so a Fed rate hike would be likely, which is why we saw mortgage rates jump at the beginning of the month instead of waiting for the announcement. So if the Fed had just announced that they were actually pausing rate hikes again, we probably would have seen a nice drop in mortgage rates today. But instead, the market guessed right, which is why we remain around 7%. What you need to understand about this is that the bond markets move smarter and faster than the Fed. The Fed is old and slow, so if you're waiting to see what the Fed does, you're already too late, as you can see by the bond markets adjusting for the move weeks ago. What I mean by this is you'll never be able to time the markets, especially not if you're waiting to see what the Fed does. By the time the Fed announces something, the market has already adjusted weeks ago. So please stop trying to time the market. But what does this mean moving forward, and how can you make the best decision today? So most Fed officials in June had penciled in 2 more rate hikes for this year, one in July, which has just happened, and the other sometime in the fall. Something else that's important that Powell said in this meeting is he said it's very unlikely any rate cuts would happen this year. So let's assume the worst case is there's another rate hike in the fall and rates go even higher. And then let's assume the best case is no more rate hikes, mortgage rates just stay around 7% for the rest of the year. Well, the evidence we've seen so far is that buyers have just accepted the higher rates and are continuing to consume all of the current supply, keeping prices high. So it's unlikely we will see prices drop, at least in any meaningful way. So your options are you can either buy now at a 7% rate, or potentially wait until later in the year and buy at a 7.5% rate. You also have to understand that mortgage rates have gone from 2.5% all the way up to over 7%, and yet prices are still at, above, or around all-time highs in many markets. What makes you think that one more rate hike is going to be the straw that breaks the camel's back and finally prices are just going to crash and you're going to get a deal? If the last 10 rate hikes didn't do anything to bring prices down, what makes you think this next one is going to do it? In other words, every single person who has said something like, I'm just going to wait and see what rates do later in the year, prices are too high, they have to come down, so I'm going to wait and see when that happens. Anyone who has said anything like this has regretted it so far, and it's been a very costly gamble. So I say this literally every week. If you can buy a home today, then buy a home today. Do not try and time the market. It's a losing game. If you buy today and rates go up, then you made the best decision you could. If you buy today and rates go down tomorrow, that's great news because you get to refinance down while everyone else is back in the market competing for the few homes. It's going to be multiple offers, it's going to be cash buyers, and it's going to be impossible to get a home. It's going to be exactly what we just went through. Too much demand, too little supply. The best time to buy an investment is when demand is at its lowest, which is now when hardly anyone can afford a house. If you wait until everyone can afford a house again, there won't be enough homes. Like I said, it's going to be multiple offers the whole time and you're going to watch prices fly through the roof and it's going to be unaffordable anyway. So if you can buy a house, then buy a house. Stop trying to time the market. It's a losing game. I'm going to keep saying it. And if you're still on the fence about whether or not now is a good time to buy a home, please watch this video. Well, that's it for me. And as always, if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. Thanks for watching. I'll see you in the next video.